Thanks for everybody having us today. As Susan said, I do practice kind of specifically in the banking and financial institution world, but it does involve a lot of M&A activity. So I can certainly chime in kind of from the legal aspect and can echo what John is going to talk about on trends in M&A from 2020 and then moving into 2021. But so let me just kind of start and talk about what we're going to, summarize what we're going to talk about today. John's going to talk about the state of the U.S. economy, government and economic policies, kind of what happened in 2020 as a result of COVID and as a result of some of those policies and how those policies are impacting and may impact M&A going into 2021. And then at the end, we'll actually have some practical guidance and some expectations going forward. And that's when I'll touch on kind of some legal aspects of M&A transactions, particularly really focusing on just some new thoughts on due diligence and how that's changed in light of COVID, both from a logistical standpoint and as far as just the things you should be asking about in due diligence versus what we typically would see in the in due diligence requests, as well as reps and warranties in a definitive agreement. And before I turn it over to John, I do want to give a shout out to your president, Derek Lipskin. I'm good buddies with Derek, so hopefully he's on here and will treat me well next time he sees me. So with that, I will flip it over to John, who's going to give us kind of a lay of the land, and we'll move over there.
Good morning, or I guess at this point, good afternoon. As we get started, my background actually is on the economy, so this is right up my alley, and I'm happy to make this presentation and be in front of you guys today. So let's start with our macro economic overview. Let's look at where the United States is now and where we were in 2020. And 2020 was a rough year. It was a rough year for numerous people, certainly, but also businesses and then our economy as well. The economy in 2020 contracted by 3.5%. We did have certainly a strong rebound in the second half of the year. So for the year, it was not as deleterious as it could have been, but still hurt a number of businesses and therefore hurt our economy. It did mark the end of the longest U.S. expansion, which began in 2009, lasted 128 months until February 2020. And once COVID hit, we saw massive declines in our GDP, 31%, but we increased 33% in Q3 2020. So we did again see a good rebound. We do expect GDP to continue to rebound this year. We look for a rebound of about 5%, according to the IMF. Our firm's projection is about a 6% increase, and then a leveling off in 2022, not only due to somewhat of a burnout, if you will, from spending and priming the pump, but also just because of the world economy is not reacting as well as we are. If you look at the government stimulus response for 2020 in April, certainly swift, substantial, and impactful. Started with the $2 trillion economic relief package, which included PPP, which was extremely successful. The Main Street lending program, quite frankly, was not as successful as the PPP, but the Federal Reserve did take forceful and proactive measures that far surpassed anything that we've seen from anything from the Great Recession. So this December, as the mantle was being passed from the Trump administration to the Biden administration, there was a second COVID relief bill passed for $900 billion. It did revive PPP. Since then, we've had another bill to strengthen and move the PPP out additional months. And then investors do expect additional spending to help cushion the economy, bring the economy back. The Federal Reserve Chairman, in his initial briefs with the Biden administration, said to go big, go bold, and certainly we're seeing that from the Biden administration. I think there is some concern that as the economy continues to grow, and certainly we're seeing that now, that they may overdo it. So that's yet to be seen. And then if they do overdo it, then you've got inflation, and you could see a pullback in 2022. So this, we're seeing a quarter by quarter in this graph to the right on the GDP. Again, the IMF sees the economy to grow by 5.1% in 2021. Our own firm looks for a growth of around 6% for 2021. The IMF does not always get it right. In fact, they usually get it wrong, but what they do is they go through and they update throughout the year. But we certainly had a number of fiscal packages to help our economy. Vaccine distribution is going out rapidly. I would assume that the majority in our group today has had at least one vaccine, if not two. And for those of us, including myself, that have had two vaccines, it is somewhat of a stress relief now to have that vaccine. So if we look at unemployment, unemployment is still elevated. We're at 6% now. We did get continuing good employment numbers today. Somewhat surprising, if you will. But one thing that is still stubbornly high is our U6 unemployment rate. The U6 reached 22.8% in April 2020. And we economists do like to look at that U6 unemployment rate because it includes your underemployed or those who have given up job search. As economies grow, you will see those that have given up a job search come back into the market looking for a job. And what you will typically see in these later stages of a recovering economy is the unemployment rate, the national unemployment rate, again, it's at 6% now. It may trend up, and it's those folks that are getting off of the U6 unemployment rate to the national employment rate. So that number right now, the U6 unemployment rate is around 11 or 12 million folks. So there still are a wide swath of people throughout the United States that are unemployed, that have given up. So I think that's why you'll see some continued fiscal stimulus, and I think that's why you'll also see the Fed at this zero interest rate policy, also called ZIRP. I think that's why you'll see a ZIRP policy continue this year, and the Fed is predicting it to continue next year as well. Of course, the Fed's always concerned about inflation, so will that ZIRP continue if we have multiple quarters? The Fed has said that they will allow 2 quarters of inflation to be above 2%. So if we do get more than 2 quarters of inflation running above 2% as measured by the CPI, I think you can see the Fed move on rates. Low rates have certainly helped on the mergers acquisition, on the expansion front. So the low rates can't be stressed enough of how they've helped our economy. Move to the next slide. So, you know, our economy, if you will, you've seen it. You may be at a corporation now, or you may have clients that there's been certainly winners and losers. You can look down the list of winners, and right off the bat, names come to mind that have certainly been winners in our time of COVID. just, be it Amazon or Target or grocery stores, your cleaning and disinfecting companies, remote working tools like Zoom. 12 months ago, we barely knew what Zoom was. So these are the winners. Now, the winners, as our economy starts to open up, will not see near the stock appreciation over the last 12 months they will the next 12 months. The losers may see some stock appreciation. The problem is some of these losers, as you look through there, will not nearly rebound and may never quite come back like they were. And I will speak to department stores, movie theaters, amusement parks. It's going to, we'll have a better view, if you will, of these certain losers in 24 months if they will be able to come back. But I'll use department stores and malls as an example. They were on the decline prior to COVID, and certainly a lot of these malls now are getting repurposed because the department stores are moving out. Our firm has worked with a number of these losers last year and into this year, and I'll use colleges and universities and technical schools as an example. We've seen and we've worked with a number of small colleges that are merging, doing mergers, restructuring, or they're becoming a branch of a larger university.
Hey, John, Mr. Robert, I would add another one of your winners is my world is banking. Banks are incredibly flush with cash right now. They are ready to do lending. So for those of you whose in-house clients are looking to do acquisitions or looking at financing for growth, the PPP money came in. They got a lot of capital, a lot of liquidity. So they're out there looking for deals right now. It's interesting to talk to the banks because they'll tell you, when I'm talking to the clients, they'll tell me, shoot, I'm my asset size and my capital size is where I projected to be at the end of 2021, not at the end of 2020. And so they're really in a really good position. And if you follow bank stocks have been doing very well as of late. Even with a shutdown economy, it's, the thing I hear is people are getting their stimulus checks or they're getting their PPP funds and they don't spend them. They just sort of keep them in the account. So liquidity is as high as it's ever been in recent memories.
Thank you, Robert, for that. So we really have seen the activity surge after the initial fall. You'll see some M&A firms, I will include ours as well. We did have a fairly robust 2020. We had a number of deals that we were working on certainly get shut down in March, April, May, start to come back in the fall. And then several of our deals wanted to close by December, by the end of the year. So, and I think a lot of that was due to the incoming administration and tax policy that may be coming out of the new administration. So we did see a very robust 2020 in our firm, and I know that 2021 pipeline, not only our firm but other firms, I've looked at other data sources. We should see a very robust 2021 as well. When you look at 2020, we saw acquirers that were pursuing a defensive M&A in an effort to survive. You did see some offensive mergers and acquisitions capitalized on distressed situations. And there was just a number of uncertainties in 2020, not only with the upcoming presidential election, but from the standpoint of how long was COVID going to last. We had good months and bad months. We had low numbers, and then we had high numbers. So there was just a lot of uncertainty in 2020. One thing that I noticed in 2020 were calls from clients that wanted to acquire firms or wanted to acquire companies, businesses, and they were surprised by valuations on the upside. And I think a lot of that was because companies, businesses that thought about selling were not going to discount their price just because they've had a bad quarter, they were having a bad year. Most businesses run and are very positive. They always think next month, next quarter, next year is going to be better, even in good times. So they did not want to sacrifice their value to sell in 2020. So certainly we did have companies that were distressed, that had to do mergers or that had to be restructured. Certainly understand that part of 2020. Quite frankly, first quarter of 2021, we saw that as well. But those that were distressed, that thought they could survive, they were not going to sell at a discount. So while 2020 did have some activity, a lot of those deals in 2020 got pushed to 2021. And in fact, some of the stats I've seen from various deal makers are that the fourth quarter of 2020, the number one concern was COVID, followed by tax policy and the new administration. Now we're looking at 2021. The number one concern for M&A is tax policy, with number two being COVID. And as Robert will discuss in when he touches on tax policy, I think you will start to see that continue where tax policy in 2022, because I don't think it'll be retroactive. Usually it's not. I think with tax policy in 2022, it could push a number of deals into 2021. Now, when we look at M&As, mergers and acquisitions, strategic restructuring, even carve-outs, if you will, those deals take 5, 6, 7 months, sometimes longer. So what we saw in 2020, if you were looking at a deal even in May or June, as COVID, again, sometimes in those months, COVID was getting better, people were understanding work from home, etc. Then those deals in April, May, June were not going to get done until the fourth quarter. So any deals that started once the vaccine came out in the fourth quarter, those deals won't get done until May and June. So we will see a very vibrant second half of the year, because now that with the vaccine rollout, any deals that are being considered in March, April, May won't get done until September, October, November, December. So again, I do think, and I just know from my personal experience, my firm and others I've talked to in the M&A world, there are going to be a number of deals done in the late third quarter and into the fourth quarter. All right, so let's move to lending. We do work with, and I know that other investment banks work with the lending environment for mid-market companies. And this segues into what Robert was talking about regarding commercial banking. Commercial banks right now are flush with cash. They're flush with cash because they're depositors, be it companies that receive money from PPP or individuals because of the payments. Banks are flush with deposits right now, as well as banks during 2020 cut back on lending, tighten their lending requirements, and therefore they've got money. We are starting to see more and more. The Federal Reserve is reporting that banks have loosened their lending requirements, maybe not to pre-COVID levels, but they're certainly seeing better cash flow from their customers, better cash flows, and you can pay on your debt. So we are starting to see banks lending again, and that certainly helps businesses with their expansion, with their technology, with their hiring. So lending levels are approaching, not getting there yet, but they're certainly getting better in any time prior to COVID. What this does for companies, it helps with their leverage. They can borrow more against their EBITDA. Higher valuations then provide a higher loan to value. It decreases in the unfunded portion of their revolving credit facilities. And again, commercial banks as well as non-bank lenders. We work with a number of PE firms that are increasing their lending as well. PE firms in the second quarter pretty much pulled back. They opened back up in the third quarter at high rates, but we have seen PE firms come back and provide lending at what I would call reasonable rates. Certainly not bank rates, but as banks get back in and provide more and more lending, you'll see PE firms lose out on that market. We did see some, again, opportunistic mezzanine and junior levels, capital levels in the third and fourth quarter. I think that will continue to a degree. We always need the mezz folks and the subordinated folks. And what you're seeing now is instead of more conditions upon more reps and warrants upon that lending, you're seeing some of that starting to pull back. I wouldn't necessarily call it covenant light yet, but we are seeing some of those covenants being removed or at least negotiated in more favorable terms. So what can't be stressed enough is the environment that we're in now, where we've got a 10-year treasury below 2%. I think we did flirt with 2% a few weeks ago. We've come back down. From a technical standpoint, there's good resistance at that 2% level. So I would look for a move above 2% to be somewhat bearish on rates. So you could see once we breach 2, you could see 2.25, 2.5. But a lot of the Wall Street firms that I follow do not think that we'll see above 2% on the 10-year treasury for the remainder of the year. Therefore, low rates help companies in their mergers and acquisitions. And I think you'll see that continue to be another reason why you'll see M&A increase this year. Okay, I did touch on the easing restrictions on debt for acquisitions, and we're starting to see this more and more. You know, a lot of deals are structured with debt. In 2020, you were seeing the acquired companies be willing to structure part of the deal with their own debt. That's going away. Therefore, you're seeing leverage multiples increase on the as a multiple of EBITDA, where pre-pandemic we were in the 3.9 to 4.1 times EBITDA. Now we're seeing that continue to move up on the larger deals. 10 million of EBITDA and greater, we're seeing that move up to 5 times. Again, a lot of this it's twofold, if you will. One, because the economy is better. While we may not have whipped COVID, we certainly have beaten it back, and therefore our economy is opening back up. But also because the world, U.S. especially, is awash in liquidity. That liquidity is trying to find deals Liquidity sitting on the sidelines earns 0%. So anytime that there's uh, a reason worth a risk, then that money uh, will find it out, and therefore I think you'll see more and more of these leverage deals come about. Buyers are that last point there, to be aggressive. Buyers over equitize in effort to bridge this leveraging price gap. Again, we talked about the rates. We're seeing very competitive rates, and I think that will continue as more and more banks, be it the mid-market banks or even the Wall Street banks, um, everyone is just awash in liquidity, and um, they're willing to lend it out, and their policies, their lending policies, will continue to be um, less restrictive as our economy gets a better foothold. So let's look at private equity funds. There may be some of you on the call that do work for private equity, and we have seen a lot of money find its way into private equity. Private equity is the forefront of the mergers and acquisition because they do have quite a bit of money. Their fundraising in private equity has ballooned. If you look at where private equity is now on the far right on this graph, there's over $1 trillion in dry powder from private equity. This was at year end. They've continued to raise money. They've continued to do deals in the first quarter, and that dry powder is still above $1 trillion. So there's a lot of money looking for deals from private equity. What we've seen also within private equity is more minority interests, where private equity will do an add-on to a company to be a part of the deal, but maybe not buy majority interest. So they're in for 10%, 20%, just to reap the benefits of owning a company as it grows, but they're not looking to lead the company and have control. And again, we talked about the cash. S&P 500 I did not include, but if you take the S&P 1000, there is a ton of money of cash during 2020, the pandemic. The S&P 500, S&P 1000 bulked up on cash, borrowed at low rates as stock market improved, issued more capital. So S&P 500 companies are awash in cash. This helps them from technology, helps them make acquisitions, and really it was the theme of 2020 was to bulk up on cash. So we've talked about M&A. I don't want to spend a whole lot of time, but M&A is coming back. We will see more M&A increase. We think M&A in 2021 will be up 25 to 30% from what it was last year. Some sectors, it could be up by 50%. Some of the losers that we saw, they will come back and they will look for deals. So certainly M&A is going to be better this year than what we've seen in 5 years on the M&A front. And again, the second half of the year is going to be extremely busy. We did touch on private equity. I don't want to spend too much time. Give Robert plenty of time as well. But certainly, when we look at firms, the larger the firm, the more of the deal size, the higher the price, and that's borne out in these deals because you typically see a larger firm has more fat to cut, and therefore larger deals will have higher multiples because they think they can cut more of the expense and make it come back into a reasonable time or to recoup the expense, the cost of doing the deal and the purchase price of that deal. So I am done. I will turn it over to Robert.
So John's kind of given us a lay of the land. I'm going to kind of take you to the end here, but he touched on the Biden tax program that's proposed, which likely won't become effective until 2022. But I think there's no question that some of these proposals, to the extent enacted as currently proposed, may have a stifling effect on M&A in 2022 going forward. One, you can see the blue box down there in the lower left corner. I mean, we've had extensive deficit funded fiscal packaging here with all the COVID relief, and there's probably more to come. So of course we have to pay for that. So that is, you can see these different tax rate changes, the corporate tax rate going from 21 to 28%. This one's a big one here, the long-term capital gains rate going up to 39.6%. And that, obviously that doesn't include the other 3.8%. So, the Obamacare 3.8%. So you're looking at capital gains taxes and personal income taxes, which is over on the right-hand side, up into the 40% bracket. And then you've got the extra Social Security tax that's going to kick in on income over 400,000. So these are all additional expenses on corporations that will likely stifle M&A going forward just due to the need to retain earnings and having to send more of it out as tax payments. And then, of course, the 40% capital gains tax, that's going to be the real kicker on M&A. And as John said, to the extent that this gets approved here sometime soon and becomes effective 1/1/22, I think you will see certainly some of those privately held businesses really look to try to get a transaction done before the end of 2021. I know in my world, I represent a lot of privately held banks, and our firm has a very robust private business group, and that has been the discussion in that M&A may pick up at a pretty hot rate towards the end of 2021 to try to take advantage of the capital gains rates before they bump up. And then thereafter, for those private businesses, what you may see them look to try to do, to the extent not changed in the tax code, is find other ways to get liquidity for their privately held business. For example, by selling to an employee stock ownership plan using 1042 elections where you can defer taxes on the gain if you put it in domestic stocks and bonds. So there may be, maybe rushes towards, alternative mechanisms for liquidity if these particular tax law changes get implemented. I mean, I think there's no question that I think there's a footnote down there that if the tax rate goes to 40% of capital gains, it'll have a pretty chilling effect on M&A activity going forward. Let's see if I can control it. Okay. So I'm not going to cover every one of these takeaways here because it just sort of summarizes what John talked about, but I did kind of make a few notes of a few I want to mention here. I mean, the COVID relief bill and the vaccines are likely to certainly jumpstart the economy here in 2021. And, that too may drive some M&A activity. I mean, we can all go around town here in Dallas, and I'm sure we've all done that, and you can look around and places are a lot more busy than they used to be. I know that traffic is a lot bit more tough than it used to be. I took my wife for our anniversary over to Pappas Brothers, and the place was packed, and they don't even require a mask. It's optional, but the place was packed. So people, getting the vaccine, I think, has reduced people's concerns, but the economy is starting to move again, and that should fuel a little bit of M&A, subject again to getting stifled by tax changes that may show up next year. Kind of the comment about deal activity, the first quarter, let's say, of 2020 was actually a pretty good, robust M&A activity period. Lots of deals signed up. We signed a couple up here. But then, boy, as soon as May hit, April and May hit, it came to a stall. For those of us here that kind of keep up with it, remember there was a big transaction where Independent Bank was going to merge with Texas Capital Bank, and they ultimately ended up calling that transaction off. That would have been a very large transaction, creating I think a $35 billion bank. But they kind of used COVID, each of them together, mutually agreeing to terminate the agreement as a reason for that, just due to the massive uncertainty, certainly at that time back in May, of going forward. In my world, the usual clip of bank M&A is about 250 banks a year. So every 4 years, we sell off about 1,000 banks. So there's about 5,000 banks right now. So in 4 years, we'll probably have about 4,000, maybe slowed down the pace given what's happened here lately. But last year, I think there were 121 transactions. So more than cut in half is what COVID did to M&A activity in my world. We had 12 deals at the firm, which put us, I think, in second place, tied for second place with another firm here in Texas. And I think the number one outfit had something like 14 or 15 deals. And usually that clip is something like 20 to 22 deals for the lead firm. And then, the second place folks usually have 18 to 17 deals. So a real hit on transactions, at least certainly in my world, but overall on M&A in 2020 as a result of COVID. I mentioned the tax increases, the concern about the tax increases that are coming in 2022. Those are going to be a tremendous concern for M&A activity going forward in 2022. And then John also touched on the massive availability of financing right now, certainly in the private equity world, where there is as John said, a lot of money sitting on the sidelines to fuel acquisition activity, whether through mezzanine lending or private equity firms just doing it themselves in acquiring companies. So with that, I want to kind of talk about now in the last part, the part you're here for probably, which is some legal stuff that we've kind of been seeing in light of transactions during COVID and then into 2021. The one thing I don't have mentioned here, I'm kind of was going to touch on just some due diligence pointers that we've been seeing. But one thing that just kind of dawned on me was given the risk and the uncertainties that still exist today, one of the takeaways that I didn't touch on, but it's in the list is, we keep hearing about these other variants of COVID. I mean, are we out of the woods yet or not? And if not, does the vaccine address the variants? Who knows? So we still have a lot of risk. So when you're an acquirer and you're looking to buy a company, you've got a lot of unknown contingent risk out there, and you've got to figure out ways to deal with that. And typically that's, of course, going to be post-closing indemnification. Your reps and warranties survive for post-closing. In my world, which is really interesting, our reps and warranties do not survive closing, and we almost never have post-closing indemnification. So one of the ways we protect on exposure after the deal is done, and the same concept would apply in a non-bank situation, is you set up escrow funds where you hold back some of the purchase price, and you have certain contingencies or conditions that have to be met or perhaps not met in order to get those funds back out of escrow and paid out to the shareholders maybe 12 months later or 18 months later. Typically non-bank deals often have rep and warranty insurance. If there's a breach of a rep and warranty post-closing that is now subject to indemnification, my world doesn't have that, but that's another way of mitigating that post-closing risk. So I think in addition to this few pointers I'm going to give here on due diligence, thinking through the exposure on a post-closing basis of the unknown risk and uncertainties that we all face in this current environment, whether it's COVID or the economy or the political environment. There's a lot of risk out there that can affect the target that you're acquiring after you acquire it. So I think thinking through those issues is also important in today's M&A environment. From the due diligence standpoint, we all know what due diligence is. We've all probably conducted it in some form or fashion or worked on it in some form or fashion in our careers, but it has changed. So we signed up a deal. I signed up a deal in August of last year, and I signed up another one about 2 weeks ago over in California. And I can tell you the due diligence process that we engaged in with my colleagues in the various areas of law that they practice in was very different than it would be in 2019, 18, and 17. A lot more specific, My world's, more about borrowers and depositors, but you're looking at key product lines, customers, suppliers. Have they been affected by COVID? Will they be affected by COVID? If I'm a buyer, what I'm looking for preferably is more broad representations and warranties, and the ability to sort of rely on third-party valuations and third-party reports and so forth, versus a seller who likely is going to want very specific representations so they can avoid foot faults on tripping some broad representation that they weren't familiar with or didn't think about. And they're going to want to limit your ability to rely on third-party information and really try to rely more specifically on representations and warranties and the disclosure schedules that accompany those. So I think that's what you're kind of looking at overall on reps and warranties and due diligence. And then just thinking through due diligence, how long is it going to be? I mean, usually, you could conduct due diligence often in 2 to 3 weeks. Well, now with the information that you need to get comfortable with what you're acquiring, probably going to take a little longer. Moreover, logistics, is the information available? I mean, are people working where you need to be? Can you get documents you need? It probably may take a little longer to get them than it used to be. So you have to kind of think through the logistics of performing due diligence in this environment, certainly using data rooms, which have become much more sophisticated than they used to be, but building in probably a lot longer due diligence period, working the logistics of due diligence, and then, kind of the period of review. You're probably going to want to look at, I recommend that you look at, going back before COVID and into COVID on due diligence so that you can compare the differences, because the post-COVID or the during COVID and maybe even post-COVID profile of the target is going to be very different, or very likely different, than the pre-COVID profile of the institution. And you want to make sure you're comparing those so you have a good idea of what it is exactly that you're acquiring. So a few areas, this is kind of compiled from working with colleagues in the various areas that kind of help me out on due diligence, because I don't know all of the stuff. I know enough to be dangerous. I can speak ERISA, for example, but it's very dangerous for me to do that. But just from a material contract standpoint, is the target still able to comply with the contract as written? Has something happened at the target, been a business interruption, something of that nature, that impacts the ability to comply with that contract as written? Has it been modified in light of COVID? And if so, how has it been modified? And can it be remodified going forward when things return to what we hope at some point will be a more return to normal? I would review and have information on key provisions about business interruption or loss of key parties, review indemnification provisions, insurance provisions related to that. And when I'm talking about material contracts, it's kind of a broad world. You're talking about the material contracts that the target has with its customers, but also the contracts that the target has with third-party vendors and suppliers that it needs. So you've kind of got to expand the scope and review all of that, because you need to understand how the third-party vendors' contracts and ability to perform its contracts with the target might be affected by COVID. Because again, in most instances, you're stepping in the shoes of that and will be taking it going forward. On the labor and employment front, really kind of want to get due diligence on worker and workplace safety, the steps taken related to same. Did anybody get COVID there at the workplace? What was done if somebody did get COVID? What measures were taken to address that? If you had workforce reductions, comp reductions, things of that nature, was it of such a size that it triggered Morn Act issues or Fair Labor Standards Act issues and concerns? Digging into those issues and concerns. Did you have work from home situations? And if so, is there a policy for returning to work? If you had work from home situations with non-exempt employees, have they been monitored correctly to account for overtime requirements, things of that nature, digging into those situations. Generally just, there were a lot of changes brought about by COVID, statutory enactments under COVID during 2020 that impacted employment and labor law, that you just got to make sure you tick off the boxes and understand exactly what the target was doing, which again is why you want to have, in my opinion, fairly broad reps if you're an acquirer trying to catch all of those various steps, new laws, suspensions of certain laws that took place during COVID to make sure you catch all those so you understand what you're acquiring. On the employee benefits side, I mentioned I speak ERISA. At one point, I was an ERISA attorney before I became a banking attorney. So, benefits for furloughed or reduced hour employees, are they consistent with the plan docs and the policies that cover those plans? Remember that you could defer, you had the opportunity to defer FICA taxes. If you did that, if the target did that, make sure you understand, how does that work? Did they accrue for it? Because if you acquire them, you want to make sure those funds, that they're going to pay them in 2022. If they were deferred, make sure you accrue for them at the target so that buyer is not then on the hook for that. So you want to make sure that any deferrals of any amounts owed are reflected in pricing in some form or fashion so that the buyer doesn't pick them up on the back end of the transactions. If you suspended certain contributions in your retirement plan, like matching contributions, is the non-discrimination testing still valid and correct? You got to check that. You want to make sure you get information from the third-party providers that run their retirement plans. This one I kind of touched on, but you want to make sure you measure, what are the normal benefit costs and expenses of the target versus what they were during COVID. So you want to make sure you know what that is, because again, if things return to normal, you want to understand what that expense is on a return to normal basis. And then recall that for your retirement plans, there were several laws that came out that affected the operation of qualified retirement plans. Just make sure the plans have been amended to incorporate those. I mean, I know that in my world, I've run across plans that forgot to, for example, adopt the hardship amendment that was probably effective, I think, back in 2019. So you want to make sure you find that and make sure their plans are all up to date with all CARES Act changes and, of course, any other changes before that. As it relates to privacy, we're in a work from home environment. Is our privacy up to snuff? Not just our privacy, but also third-party service providers' privacy. We're working from home now. A lot of people are working from home, which means perhaps we don't have the same securities in place because you're not connected to the network at the office. So just making sure you have robust privacy controls and security measures in place, and understanding what the target does in that regard, because you don't want to have a breach on a future date after you make the acquisition. As far as the kind of last few here as we wrap up, insurance, have any claims been made as a result of COVID-19, whether that's, I don't know what COVID is, I guess I reversed that there, COVID-19, whether by the company, did it make any claims on its policies, or did any employees make any claims against the company's insurance policies as a result of COVID-19? And then certainly this review this was a reality here. There were several policies that had exclusions for things like pandemics. So make sure you review all those insurance policies, understand what their exclusions and their carve-outs are for, particularly as relates to pandemics or matters related to the pandemic. Because again, we don't know exactly when we're going to be out of the pandemic. And then the tax one is more of a catch-all. There were numerous changes to deal with taxes. You had pushed filing deadlines. You had the ability to defer FICA. You had companies that received PPP. Were they eligible? Will it be forgiven? If not forgiven, how is that going to be handled? So kind of there at the end is just kind of that catch-all on understanding all the changes related to the tax code and how the target company handled those. So with all this in mind, what I would say is if you're a buyer, your reps and warranties are probably going to be a lot more that you're requesting, a lot more lengthy, a lot more robust. I think as somewhat broad to catch as much as you can. If I'm the target, I'm going to try to skinny them up and be a little tight on the reps and warranties to get them to be very specific. But in my transactions, if I'm the buyer, I usually have something like 35 or 40 reps and warranties that I want the target to make. I know that when we did some of the transactions during COVID, that grew to something like 50 reps and warranties, and the disclosure schedules got a lot more thick than they used to be, because again, you're trying to obviously identify and quantify these risks, many of which at this point are still somewhat unknown. So I do think that drafting acquisition agreements during COVID is going to be a more of a challenging exercise than in a typical, just a typical year.